Kuala Lumpur Research Seminar Series. We have the honor to have tonight or today, good morning in Malaysia, good night in DC or Minnesota. Tonight we have the honor to have Illenin Kondo, who is a research economist at the Federal Reserve Bank of Minneapolis. Prior to joining the Minneapolis Fed, he was an assistant professor at the University of Notre Dame, and before that, he was a senior economist at the Federal Reserve Board of Governors. His research focused on quantitative macro models of sovereign debt crisis, trade-induced labor reallocation, and the optimal design of infrastructure networks. He holds a PhD in economics from the University of Minnesota, and he's gonna present his paper on borrowing in the shadow of China. So thanks a lot, Illenin, again, and the floor is yours.
Thank you very much, Agustin, and thank you again for the invitation. I'm very happy to be here. Just before getting started, the usual disclaimer, these are my views alone, not the view of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. All right, so this paper is titled Borrowing in the Shadow of China. It's joint work with Asik Mactarian and Cesar Sotapadilla, both from Notre Dame, and Cesar is visiting the Minneapolis Fed this year. All right. Just for everyone in, at least on the WebEx side of this, feel free to ask me as many questions as we go for clarification. I baked in enough time for that, so don't feel, don't be shy about it. I actually enjoy interactive seminars. All right, let's get going. So the broad motivation for our paper is one that I think is probably familiar of those who chose to come to the seminar today. It's pretty simple. Yeah, I'm an international trade economist, so we've talked a lot about the China trade shock, but there has been another quite massive Chinese shock, which is the rise of Chinese lending to developing economies. China has basically become a major lender to developing economies. So in the table below, let me try to see if I can use the annotation tool well. So in the table below, I'm showing you from 2000 to 2015, a couple of data points on the rise of Chinese lending. First, just how many countries actually are reported to be borrowing from China. We see the number going from 15 to more than 100 countries by 2015. This is coming from data where we are using the data from the thorough investigative work of Paul Reinhardt and Trebesh on Chinese lending. How big is this? Well, the Chinese, for the median country, and there are some countries are heavy borrowers from China, but at the median, these numbers were relatively small in 2000. We're talking about less than even half of a percentage point relative to GDP. By 2015, that number was much higher, about 5% of GDP. How does that compare to the debt burden of these countries? Well, if we compare the Chinese debt to the external debt in the hand of bondholders, it's also quite substantial. It rose from being very little to now being as high as the equivalent of 2/3 of the external debt, not the overall debt, the one in the hand of bondholders. So obviously that number is skewed because some countries don't have don't necessarily show a lot of external debt in the form of debt held by bondholders. And similar, if you just compare it to the external debt overall for these countries across all lenders, it still is quite substantial. It rose essentially from 2000 to 2015, it rose to be about a quarter of the overall debt. So no matter how you look at it, the rise, China is a major lender to developing countries. So let me quickly. All right. So against the backdrop of this sort of rising Chinese lending, we know a few things. The Chinese lending to developing countries is quite special. The developing countries debt to China is not only large, as I just showed you, but it's also relatively opaque. And it also has become a growing source of concern for other lenders. Markets, in a way, have to take into account the size of the debt the countries have vis-a-vis China, but also the characteristics of that, and figure out sort of to make me figure that out in the context of limited information. So what we do in this paper is that we choose to sort of focus exactly on those on the market interaction with China. So we want to study how the nature or some characteristics that I'll spell out very shortly about the official borrowing from China, how that is impacting market prices and market quantities. So how does engaging China as a borrowing from China, how is that changing the prices a country faces on the market? How does that change the country's borrowing strategy on international capital markets? That's sort of the broad theme of this work. I'm not sure if there are questions so far. I just want to make sure I'm not going too fast or too slowly. I can see people, but okay. All right. So let me be just very clear about what we do. The paper is going to have two parts. It's going to have an empirical part that motivates a few facts, and it's going to have a modeling side. The first thing we do is that we basically combine the baseline data set by Horn, Reithan, and Trebesh, which is basically a data on not just sort of that stocks vis-a-vis China, but also events associated with that, whether there are restructuring and others. So we take that data set, and then we basically also take data on the prices and quantities, if you want, of debt on capital markets. In particular, we take bond level data for the countries that are engaging international capital markets, and we compute, so for each of those countries, a few things, a few measures such on their sovereign debt issuances, but also on the yields they face. So that allows us to sort of combine what we were starting to learn on the sort of the size of Chinese lending, and occasionally good or bad events associated, which is more Chinese lending or more Chinese funding or maybe restructuring. We combine that with data on some things we see in markets, essentially prices and quantities, or prices and quantity. And what I'm going to show you in the next few slides is that Chinese external borrowing from private lenders tend to be lower following inflows of lending from China. And I'll show you how we do that. I'm also going to show you that sovereign bond yield decline. So after following Chinese lending events. So when countries borrow from China, we tend to observe that at the same time, it's a little cheaper for them actually to borrow. So it's cheaper. It will be cheaper for them to borrow in international capital markets. Of course, fact 1 and 2 are related, and I'll discuss that when I talk about the theory a little later. The third fact we document is that it's not completely a free lunch, in the sense that while inflows tend to potentially look like things that sort of associated with like low, cheaper borrowing terms, less expensive borrowing cost, and sort of a source of deleveraging from capital market, we see that restructuring events or news of restructuring events as with China have a very sharp effect. Sovereign bond yields really increase very much and a lot, and I'll show you that later, when countries are in trouble with China vis-a-vis the debts they have. So we're going to sort of put some numbers on that. We're going to tell you how we do that. And then we will turn to a model that says, okay, how do we make sense of that? And I'll then tell you later how we are thinking about using the model to go back to the original motivation about information friction and lack of, and not knowing fully the contours of the debt. But what we're going to do on the model side, and so this is a little bit of a preview of what we do, is that we're going to take a very relatively simple state-of-the-art model of sovereign default. So it's going to have a few standard features. Now, and it's going to have long-term debt, and the goal will be sort of to think about a few frictions on top of that model that can help us understand the facts we are having with China. In particular, we're going to take a specific stand on what it means to have Chinese to have borrowing from China. Where we're going to take the stand that we want to think of Chinese debt as a debt that is characterized by essentially a rollover risk, which is when you borrow from China, you may not completely know when there's a probability that at some point the repayment, a large repayment might be due. We're not modeling microfounding that. We're going to tell you the reasons why we think that's an attractive way to think about the data. The second thing, and that may just appeal more directly to people in terms of what they've read in the news about the Chinese debt, is that you're not going to be able to walk away from the Chinese debt. So unlike the market debt on which you can default, for a variety of reasons that I'm sure everyone has read in the popular press in terms of potentially how quote unquote collateralized the Chinese lending is, we're going to just assume that you're not going to be able to walk away from this debt. So this is debt that you can take on, that can turn against you occasionally, or there can be more of it, but more importantly, you don't walk away from it. So for people who are sort of in this literature, Chinese debt can have a flavor of sort of having a little bit of a sudden stop flavor to it because you have to pay back suddenly a lot. But this then interact with endogenous default risk on the market debt, meaning as countries either receive more from China or occasionally have to face this rollover crisis with China, how they behave on the market and how much they lean and depend on the market is changing. And then we're going to use the model to see how we can make sense of how the model helps us understand what we see in the data. What I will show you is that the model can help us rationalize some of the stylized facts we see. And then we can conduct some welfare effect in terms of welfare exercise in terms of thinking across the states if these how welfare improving as these relationships. But that's a benchmark, and then I'll show you. But I will show you results for that. Is like how we are now going to think about embedding a little bit of this opaque nature of the Chinese lending terms in the model. Today, I'll just show you a couple of equations to tell how we're thinking about that. I won't have results for that actually. I come from Minnesota, as you guys know. So going 15 minutes without questions is like either I'm doing something completely wrong or I'm joking. Feel free to question. That's what I'm really trying to say. All right. So
I have a couple of questions.
Okay.
Yeah, I mean, I know that this is maybe out of the scope of the paper, but because you don't modulate the behavior of the government, and you already of China, sorry, of the Chinese government, as you already mentioned it. But do you have like an idea of what are the incentives of the Chinese government to lend to these many countries? And also the other question is, I don't know if you have a picture of how much of this Chinese lending goes to the East Asia and the Pacific region, and how does it compares with other regions like Latin America or Africa?
Yeah. So you do have a couple of questions. So let me take them one by one. On the maybe I'll take the last one first because it's easier just in terms of the comparison. I don't have the breakdown by region here, but as you can suspect, this is pretty much correlated a little bit with some of the other big initiatives that that China has around the world in terms of the Belt and Road initiatives, other strategic motives, and to the extent that those are global in nature, you do pick that footprint, meaning we're going to have countries in Central and Latin America, countries in Africa, obviously, countries in Asia. So the data set is going to be relatively broad in that sense. It's not just emerging economies, it's also going to be developing countries. What's going to happen is that the data set is also going to pick up you will see that when I show you the sample size, you're gonna see a sample when the sample size drops. There's gonna be a lot of developing economies that we probably wouldn't qualify as emerging because they don't typically engage in international capital markets that seem to be leaning a lot into this Chinese lending. So it's almost like an extreme form of this first fact when I say when you get Chinese lending, you borrow less from the market. Some countries that were essentially the point is the countries that don't participate in international capital market have very high level of Chinese debt. So and then you have the usual suspects, some key commodities and things like that. I don't have that here, but when I show you the result, I'll go through the list of countries in the data set you'll see. But that leads me to the answer to your other question. So this this may be too far ahead for some people in the talk. Maybe this may be the right time, but I'm gonna return to this when I show the model because I can be more specific. But what I can say is that for now, I want you to think that there's a world where you think the Chinese behavior is exogenous, and you still can ask how that exogeneity is affecting market quantities and prices in a world where the market and the government, meaning the borrowing government, are rational. Or there's a world where you think you make that even extra complicated. You endogenize essentially things that look like the relatively cheap lending terms that China may offer, but also you also have to rationalize other things that are reported, which is the difficulty to renegotiate the debt, which is the fact that in some cases there have been instances of sort of seizing country assets, report of seizing countries' assets when there is a difficulty to repay. So we chose sort of, instead of going to that endogenous, right, which is what, as I mentioned, ASIC tried to do in her thesis, to not to do that. But I want you to think about those things, which is there has to be a benefit to the Chinese lender to extend both loans at least at face value a price that may be seen cheaper, or at least not relatively generous. But more importantly, there has to be a reason to the nature of the contract extent. The collateral. Can you walk away? How hard is it to negotiate? Why can't we negotiate with the other countries? So that's a long answer. Long story short, relatively global footprint for these lending relationships. The Chinese authority, the Chinese lending agent is just going to be a completely exogenous object in the model. We should do more. Okay. All right. So because I'm not going to go to the model until I show you more.
I think Shafat has a question before you.
Okay, of course. Was I supposed to see something flashing when he said he had a question? Just jumping, guys. I'm not going to be able to know when you have a question.
No worry. I can let you know.
No, just speak up. Yeah, go ahead.
Okay. So yeah, I think this is interesting. So what I'm getting is there's a different borrowing technology which has a higher cost of default and lower spreads because of that. So do you see some behavior on the real side which changes when you have more borrowing from this technology? Is it like do you start trading more with China? That would also because this is interesting. It would be nice to see how countries react differently when they have this technology of borrowing.
Yep. No, that's a very good point. In fact, I had a student who wrote a senior thesis at Notre Dame exactly on that topic, and he actually had some interesting funding because what he was doing is, he was using the input output. Essentially, he was able to trace Chinese demand and the Chinese line and this lending terms to see how it was showing up in trade. Essentially, our trade flows, essentially responding to. You need essentially you can use something like, think of it like the Belt and Road Initiative as a shock that drives the debt, but then you use sort of think of it a lagged sectoral demand for soybeans from Brazil as opposed to oil from Angola, to think about whether or not when Brazil borrows loans in China, because of the Belt and Road, if the trade and the exports are actually responding to that. It's funny. I went to a conference on infrastructure. I'm not sure if I should be saying all of this when we're YouTubing live, but in some countries, at least in some African countries, I've heard notions where sometimes even the accounting of how much is actually being exported to China in this context is not as there can be a lot of the reporting is not as complete as one might think in some contexts. But I think it's a really important theme because so I hear a question in two ways, Shafat. One is just, I'm going to tell you something later about productivity. There is a question about whether or not Chinese lending can actually change productivity. There's also a question simply about, I mean, in my model, I'm not going to have trade, but I can also think about essentially the flows of trade changing and shifting to China on their own because of this, which can be an interesting fact. He did only a senior thesis, so it wasn't completely polished, but that was a neat idea. Anyway, so there are some effects, I suspect. All right, so back to what we do, not all these other fun things that we're not doing yet. Let me tell you one thing about the model before I jump into the data. So the way I want you to think about this, as Shafat put it, this other lending technology, and he put it right, which he says it has a higher default cost. In fact, I'm going to push it to extreme. You cannot walk away from it, so you have to pay it back. It's infinity. So it's a non-defaultable debt, but it has rollover risk in the sense that when you take it on, you don't really know when you're gonna get in trouble with it. So why do we think this is reasonable? They have all these like no Paris Club like clauses, as people think this is resource back. These are resource backed loan. When in 2020 Zambia had issues with Eurobond, there wasn't talk as we know about sort of them not paying back China. So these are sort of ways to think about that. Then now when you take this technology, that restructuring in the model, the way I'm going to think about it, is going to be akin to exactly as I said before, like a sudden stop and a negative output shock. Why is it a negative output shock? Because in a way, sort of, it's as if you had this flow that was coming in, and all of it, you have money that, if you only had out endowment, it's as if essentially endowment is falling. But because it is an open economy, because it's flowing out, it looks like a sudden stop. Having long-term debt matters here, both because it amplifies this rollover risk, and it interacts with default risk, as we know, because of how long-term debt and default interact. But at the same time, the upside, if you want, the Chinese debt relationship is that it allows you to deleverage away from the market. So if you're a country that happens to have this good sort of windfall from China at a time where you're sort of a little more fragile on international capital market, let's say bad output state and things like that, this is really good because it can really sort of do a lot in bringing down your sovereign spread. So that's going to be what happens in this very, very simple model that I'm going to show you. So I'm now going to sort of move forward and tell you a little more about the data, and we'll circle back to the model. So what do we do? So as I said, we're just going to take country level data. The data starts in 2000 because, as you saw, pretty much there was no China debt. Pre-2000, nobody will have, even as of 2000, nobody will think of sort of China being a major player. Data started in 2000. We're using some external debt statistic from the World Bank, from you guys, I guess, and international debt statistics. Critically to this project, we have to rely on the very, very important work that Reinhard and Trebek have done, because knowing how much a country owes to China at a point in time is actually really, really hard. And there are a couple of projects, obviously, that were doing the same work before they sort of compiled their own database. But this is a key input for us. So we're going to use the estimated debt stocks in Horn et al. We're also going to use sort of discrete events that are going to be called Chinese debt restructuring. We will construct ourselves using the debt stocks, what we call funding events. So now that I can see the series of debt stocks for Horn et al., I can call some things that, oh, this is a major funding event. I can also see when the country has been in trouble with China. The third piece of the data is this piece that essentially is that it's not hard to do. We just take the universe of bonds we can see in Bloomberg on the countries that have had a relationship with China. So obviously, many of these countries that borrow from China are not borrowing in international capital markets. We know that. If you've played with Bloomberg data, you know that you don't see, especially for the countries, for emerging countries and certainly for developing countries, you don't see them continuously. And that will matter for my data set because some things I can see easily, some things I can't. So the data is not going to be completely balanced because of this the intermittent coverage in Bloomberg and limited capital market participation for the countries that engage with China. But we are still pulling in sort of the universe of the bonds we can see in Bloomberg from these countries. And we use those to construct essentially country year level international capital market statistics and measures that we're going to on prices and quantities, if you want, that we for analysis. So what's the benchmark, simplest way to think about the exercise we do from the empirical findings? We're going to have essentially this, I wish I could say, we basically have to have this data which, depending on what I'm using can be a fully balanced pattern or not. You'll see why in a second, but we're going to have I is going to denote a country, and T is going to be a year. As I said, we're talking about essentially 16 or 17 years of data. And we're going to sort of have two types of Chinese debt event, if you want. One can be a Chinese funding event. So this is a windfall, helicopter drop from China. This is going to be when the inflow from China is large for that country. And then we're also going to have restructuring events that are hard-coded events that we've collected as restructuring. So that's going to be the China debt event. And then we're going to look at some outcome Y. Typically, we're going to think about, as I said, prices and quantities. When we think quantities, we're going to either use sort of the broader international statistic measures, or we're also going to use issuance data that we construct from observing bonds in Bloomberg. We're also going to obviously look at market debt prices. So we're looking at sort of China, the red variable, against sort of how the market is responding. Obviously, there are a lot of things to worry about. I'm going to have country fixed effect, time fixed effect, control for a bunch of things that we'll worry about, like foreign reserve, growth, control for a few other things, such as, depending on the specification, when I'm looking at prices, I will actually do a lag specification. So I'm going to have lag prices. I'll have controls for lagged, some notion of lag debt, to be able to take into account, obviously, the fact that the level of the debt matters also for the prices. So this is sort of the benchmark way to think about some of the results I'm going to show you very shortly. Okay, so again, I'm going to have this discrete event with some controls about both about these countries, and I'm going to be looking at sort of notions of how in the international capital market these countries are, how much they're borrowing or how much they're issuing, and how was the cost of that. Okay. All right. So let me show you my result. Result number one. I'm not sure if you can see the top of the slide because I have the okay, maybe it's better now. So the first result is that we found a Chinese lending. So this is Chinese funding event, right? Inflows from China are associated with, think of it as market debt deleveraging. So you borrow less from international capital market when China is basically lending you more. So how do we show that? So I'm going to show you a few specifications here. Note I have quite a few countries. So, you know, so in a world where I have about sort of 15 years of data, this is quite a few countries. So the simplest specification is one where all these regression are going to have country fixed effect, time fixed effect. I'm going to control, they're going to be a lag specification. The key dependent variable I'm using here in this table is using the bond level data, I construct country level estimates of new bond issuance. So I'm just sort of asking how many do you have a new bond issuance in international capital markets? And essentially, you can think of this as the simplest way to think about it is whether or not it's a linear probability model, if you want. So essentially, you're less likely to issue a new bond in international capital market when China is lending to you. This is relatively robust, whether I do it in level. There is what we do here is that sometimes some countries have multiple funding rounds from China. So you can basically sometimes restrict yourself to the specification where you're only looking at the subsequent rounds of funding from China. You still get some identification from that. We can do it in change. The results are a little better. We also do a specification where you can say, well, if the shock is really sudden and you really think that we have this, like all of a sudden you engage in China and then you have more from China, because a few countries have like a couple of rounds of funding from China, the last specification tells us that a world where you just do a kind of like a pre-post China, but when the pre is different, meaning the first year a country borrows from China is not 2,000 for all countries. As you saw, that number of countries borrowing from China went from I think 15 to 106 over those 15 years. So this specification is really sort of based on the fact that different countries are entering into borrowing relationship with China at different times. The big picture here is I just want to convince you that what we do tend to see is that inflows from China, you borrow a little less from international capital market in the sense of a new bond issuance. It didn't have to be this way. Yes, go ahead.
Illenin, a couple of questions. One is about the timing. Here you have that Chinese lending event in time T affect the debt level in time T, or you have lagged the Chinese lending event? And the other question will be exactly what is if you have an idea of what is the effect of this Chinese lending event on the debt level over time, like one period after or two period after?
Yeah. No, those are very good questions. The baseline I use here tends to be that the event is occurring year T, and I'm also asking if there is issuance in year T. And then I've done versions where you do it in T. I'm not sure if it's I may not have it here, but I do it in T and you do T+1. I haven't done the full sort of more dynamic stuff. The results are relatively robust in that dimension, but it depends how you do the last part in terms of just tracing it out. Yeah. So I mean, this one is the reason why this one is also tends to be robust is just because you have more countries to play with, and all right, and you anyway. I'll circle back to this later. So
because just one more comment, because my concern is that, I mean, I know this is only a correlation. This is,
of course, yeah.
But maybe you borrow from China just because you cannot borrow from anyone else, and that's why your debt from the credit markets also decrease, no?
So if that is the case, at least from the perspective of, so if to the extent that, so for instance, in this case, yeah, so I do a few things that depending on the specification, you may have to worry about that. If over and above the country fixed effect, which you capture, like, whether or not a country tends to have higher or cheaper prices, I control for lag prices as well. You can say, okay, that goes some ways. But honestly, I agree with you. Like, these are correlations I really want to show you. I'm not arguing, and the best way I think I'm teasing the sort of the effect here is just to both do a lot of adding quite a few controls that sort of models tell us matter and existing practices tell us matter, but also, as I said, just doing it. I think the change specifications to me kind of capture the bulk of that story. Meaning, in this case, you have to worry that the change in it's as if like I go exactly to China or China shows up exactly when they know that it's really hard for me to borrow. So yeah, I mean, if you worried, I mean, of course we have time fixed effect here, but what it means is that if you had like other things such as like more like global big stuff and things like that, it will pick that up as well. And we did that. But our story is different. You want a country specific freeze. It's like essentially, let me push it to an extreme. The second you freeze Russia for international capital market, all of a sudden they have a boatload of funding coming from China. That will basically completely destroy the model, and that will be true. I don't think that's what's happening based on the other things we're doing, but that's obviously part of the story. And I think to the extent that some of these, so these are the countries that are already engaging in international capital markets. But I know it's a point well taken. Yeah, and an excellent point. All right, so let me try to sort of get through some additional results, because I'm a Minnesota guy, so if I don't show you a model, I'll have a headache. I'll be like, what just happened? All right, so second fact is that, actually, excuse me, I knew I skipped a slide. I went to slide 10 as opposed to slide 9. So the first result I actually wanted to show you was actually using the international debt statistics. But the point here is, this is simpler in a way. That's why I was supposed to show it first, but I clicked too quickly. I'm basically running the same type of regression, but here I'm using just the external debt in the hand of bondholders that this country has. So this is not using any Bloomberg. This is basically using sort of Reinhardt, Horntrabesch, and Reinhardt data against this international debt statistics. It's the same story, essentially. Obviously, there's less debt in the hand of bondholders. This is the bond issuance one. Now I'm going to go to prices. So now I'm going to look at, notice by the way that this sample size had like 600 observations. Now it's gonna drop to 300. Why? Because I'm gonna look at prices. And what happens in Bloomberg is that when I see a bond, in 2000, it may have been issued when I say bond in 2020, it may have been issued in 2000. So that's good. I can go back. But when I want to look at prices for a bond in a given year, it may not be in the data at that time. So that really shrinks the data set, because the continuous coverage of prices for a given bond is just not so good. So it's going to matter, because for some of the results I show later, and I'll tell you why. But I'm going to look at sort of, when I see a bond, I know if it's a long-term bond or not, and I know what country is issued it, and I know the yield. Now I'm going to ask, okay, using the same strategy here in everything I'm doing here, know that I have lagged. When it's not a change specification, I have the lagged bond yield. So I'm asking if how a funding event is correlated to bond prices, bond yields in international capital markets, right? So the result here is that think of it as, on average, large inflows from China are associated with, roughly speaking, about 85 to 100 basis points lower bond yield. So this is substantial. You have, again, as I described, there are a few ways of doing it. different ways of identifying whether you only use subsequent funding events and others. But the big picture is that so that at this point I want you to think of it as China funding events, deleveraging from markets, and also lower prices. Obviously, the previous fact can rationalize part of this one, the previous fact on deleveraging. Now, the last thing I want to do is that I want to now take the same type of event. I want to change the type of event. I'm going to ask about restructuring. You don't have as many restructuring events as you have funding events. And the identification is also going to be a touch trickier because most countries had more than one Chinese funding. So there's some element of within country identification going on. Restructurings are not as common. It's a rarer event. So every time I'm going to show you, it's going to be the same spec, but I'm going to tell you in a second why it matters. So what am I going to do? I'm going to ask the same question. I'm going to ask how a Chinese restructuring event is affecting bond yield. This number is massive. It suggests that bond prices just snap up a lot. 300 basis points is the point estimate. It's huge. I had to check a few times, and I'll tell you a second something about it. But before I tell you that, I'll say, well, you may at this point ask, is China really special? And I could have done it for the other things. But what I want you to see is I was like, is 300 basis points really big or really small? Well, if you take those same countries and ask how having a Paris Club restructuring event affects international capital markets, it actually has the same point estimate. So the point is the size of the effect of a Chinese restructuring event on international capital market bond yields is actually may not be outsized, at least by this measure. Now, the one thing I want to tell you is that I look hard into this fact because it's important from the perspective of identification. And actually, I thought it was revealing. There's one country that actually drives these results because it's one of the few countries for which I have seen multiple restructuring events, and that's Venezuela. And think of this as if I didn't have Venezuela, my design may be weaker because I don't have as many. It will be too many. It will just be mostly a cross-sectional fact, and the fact is not as robust. But I mean, it's what it is. It's like trying to run a regression like default events. They're rare. So like, but that's what it is. And going back to your question earlier, Agustin, in this case, like it was very clear that, and in the paper, we mentioned the countries that are for which we have those restructuring events. There are a handful of them. Venezuela in 2015, 2017, Ivory Coast, Angola, Ghana, Sri Lanka, Nigeria. So those are the countries that are sort of Zambia, obviously, in 2017 as well. So these are some of the countries that we have here driving this event. All right. So in summary, I'm hoping, even though you didn't ask me a lot of questions besides Shafat and Agustin, I'm hoping that so far you're on board with me, that I have some stylized facts. I mean, the stylized because, as you can tell, the data set has its strengths and weaknesses. But what I want to tease out is that it seems to us that external public debt is lower, about 10 to 2% lower following Chinese lending events. International sovereign bond issuances are less likely, about 10 to 15% less likely following Chinese funding lending events. And sovereign bond yields decline by almost 100 basis points. But sovereign bond yields can really snap up when there is, I want to say, some Chinese debt crisis, namely in the measurement we use, Chinese debt restructuring events. So maybe at this point we could stop and work out on identification and say those are the facts. But no, it's good to kind of ask ourselves what's really happening, especially when we're talking about relatively rare events, meaning a world where prices are driven by credit risk maybe and default risk, which is a rare event to observe, and a world where things like China funding this funding restructuring event are also relatively rare events. It might be important actually to use the model to help our discipline also just how we think about it. So that's what we're going to do. We're going to offer a model of market debt and prices, so a standard sovereign default model, but with some notion of Chinese official debt with the characteristics I described earlier. Okay, so how do I do it? It's going to be incredibly stylized, super stylized. And as I go along, I'll tell you the ways in which you can make it a little fancier, but in some way it will be complicated because you don't do sovereign default like this is a big model. But if you do, you'll see how it's really simple. A small open economy that basically has, in discrete terms, so one good. And you have an endowment process Y. So there's this tree, you can call it soybeans tree or oil tree or whatever is your favorite analogy for your favorite country that may be borrowing from China. and from international capital markets. So you have an endowment process. Y follows a market process. Now, the third bullet point is the first time where we introduce something like China. It's going to be very simple. It's your debt level vis-a-vis China. It's called B for bond, for debt, B, and subscript C for China. It can be only two numbers, high or low. So when the debt BC goes from low to high, that's an inflow from China. And when it goes from high to low, you have to repay. One way you can think of this, that is actually a very persistent process. We have relatively small sort of repayment or inflows and outflows, and occasionally have very large adjustments to the stock of China, or you have to if you. So obviously, the inflows are going to be a funding event. In the model, we're going to think of these outflows as these restructuring events. I'm going to say, but the challenge, what's going to happen is that this is going to be following, it's going to be a stochastic process. So when you have to sort of pay up, meaning switch your debt level BC from BC to B low, BC high to BC low, it's a random event. So you carry this thing, and occasionally you have to pay it back. And at the same time, you have a market debt B, which is long term, which is a fraction delta of it matures every period. And they have a fraction minus delta that's over the next period. And obviously, critical to have what's critical in our model is that this market debt B has credit risk, so you can default on it but it's costly. Okay, so that's it for thinking up. So this slide shows you that this is debt you can't walk away from. It shows you that it's debt that has a feature of a rollover risk in the sense of the stochastic transition from where you have to repay back. And so it has minimal features that already allow us to start thinking about the frictions we have in mind and how far it can take us. Okay. All right. So just a simple, it's notation. It's nothing crazy. This states exactly what I just said, which is when we're gonna have this shock A, which is the switching from high to low, and when there's no switch, then you just get stuck at you don't have to change anything. And when the A is on, then you basically have to pay. When the A is on, you have low, you get an inflow and vice versa. And the debt position change. So this is simply, there's nothing special. So let me state this. Obviously, this is unfortunately sort of the standard heavy equation, but I'm gonna walk through it. I'm gonna try to walk through it slow. So let me try to use that notation tool here and try to do this. So the government has to solve a problem where it takes as given the debt it has on the market. This is the market debt, the market debt B, right? This is from the market. BC is the Chinese debt he has on hand. The state of the economy is going to be two things. This is the output Y, and this is whether or not you just experience this China adjustment shock, right? Meaning if you had BC low and A is equal to 1, that's an inflow. And if you have BC high and A is equal to 1, that becomes that becomes, I'm sorry, I did something I should not have done. I played with the I played with it had something that's a restore last notation, and okay, all right. Anyway, so the exogenous state here contains the stochastic process for the Chinese debt and the endowment. Okay, all right. So what does the government have to choose? Well, whether you repay or not. So D is the decision to default. When D is default, then you basically you clear your market debt. There is no debt B due anymore. And otherwise, when you choose to repay, we have to sort of work on the we have to sort of trace out what you get. Well, let me slowly walk through this equation when you choose to repay the debt and not default. The resource constraint shows that this is the endowment Y of the economy. This is sort of the net international capital market issuance, which is, I mean, not, I'm sorry, I spoke too fast. You have to pay kappa B, okay? That means you have 1 minus delta B that's left. It has a price Q that's going to be endogenous that you take as given, and you choose a new amount B prime. So B prime minus 1 minus delta is going to be sort of the net debt inflow from international capital markets. All this part is standard. What for us is special is that you have this new term that captures the adjustment vis-a-vis China. So you can see how the red term, the adjustment vis-a-vis China, could have just looked like a Y shock. That's the sense in which the Chinese engaging in China in this, the engagement in China here can just be akin to more volatility, output volatility, if you want, or changes both levels and the stochastic profile of the output. Well, there's going to be more for that for us because this Z has to basically to be shipped to China. So that means it's not just like the endowment, our soybean farm has more soybean that we eat or not. It's, there's an outflow associated. That's the sudden stop flavor of it, right? It's large, it's going to be large and not small. Otherwise, when you choose to default, you pay standard default cost fee Y. We can circle back to this later because
Illenin, I have a clarification question on the previous equation. So what is the pricing of the Chinese lending here? Only one unit of consumption and
yeah, that's it. Yeah, it's
okay.
Exactly. Yeah. There is no going back to the comment Chef had made earlier, he suggested it was high default cost and he said something essential about the price is being cheaper or something. We don't have an endogenous price here. In fact, if you try to price the stream that I'm going to describe, we can do things to make it anyway. To your question, yeah, it's just one good is the same good and you have to pay back later. Okay.
And for example, looking at the data, how I mean, is this a strong assumption? I'm thinking especially in the welfare analysis that maybe if you increase a little bit the cost of this Chinese lending, even though it's lower than borrowing from the market, it will change the results, right? But I mean,
yeah, no, I think what the way I think about it is that I haven't done the exercise you're thinking about, but the way I want you to think about it is that if you were modeling the Chinese choice about the BC, and if you allowed a non-economic benefit to China, meaning something that China benefits from, but that's not in the space, that's not paid with this good, think of it as strategic position in latitude X, longitude Y, then that will be look from the perspective of the model as a counterfactually cheaper. So as long as I think I haven't played with different levels of how good of a deal it is, but what I want you to keep in mind is that by not modeling China, I do want you to keep in mind that there's an unmodeled non-economic benefit that should rationalize sort of deviations from sort of the market price, even if it's sort of risk-free. Okay.
Perfect.
All right. So, but one thing I wanted to mention is that the model is simple because there's a world where you can think of the default cost on the market potential depending on the relationship with China. So this fee still has. That's why. So I'm not changing anything really except from adding this Z process if you want and the exogenous state A. But we could do more things on that dimension if you think of some of the stories in newspapers. So simple model. Q, the blue object, is different from the standard object because you have this China debt dynamics involved. And then the model itself in terms of the fluctuations, the output fluctuations that the country is trying to ensure by borrowing and lending, by borrowing, and to smooth consumption. Well, that price has to take into account the fact that the default decisions and the borrowing decisions B prime depend not just on the output fluctuations, but also on essentially the China risk, if you want. The China boon, the fact the China boon can turn against you, and that it's stochastic. Okay, so what do we get? Standard pricing equation in some ways, because you're going to get that the price that the market wants to charge if you want to borrow B prime, knowing that you have a debt B prime vis-a-vis China, is going to take into account the repayment, the fact how your repayment risk is changing, but also how your future decisions to borrow. So the model is going to load on the two standard channel on long-term debt, which is the standard that essentially the price reflects the default risk, right? Now the default risk obviously is endogenous to the China dynamics, but it's also the model because it's long-term, is going to have the fact that how the prices of the outstanding debt respond to your future, your new borrowing. But here, this matters because your new borrowing will depend on what happens to China. Think of a world where you have to pay up tomorrow. Your debt has to go. You have to basically pay back China a lot. One way you can smooth consumption when you have to pay back China a lot is to borrow a lot from the market. So obviously, the dilution risk here is going to basically pick that up, for instance, over and above the fact that default risk itself responds to that. right? Meaning there's a world where if I have to pay China and also have to pay the market, but I don't want to be hungry. Well, if I may choose, I don't have the choice to pay China, I pay China, but then I may want to walk away from the debt. That's basically affecting the repayment probability, right? All right. So standard Euler equation in some ways, but at the same time, you can see exactly how this simple tweak is affecting these two key margins. Standard definition of an equilibrium. I know I'm a Minnesota guy, but since I don't have a lot of time, I'm just gonna say is the standard and good definition. So how do you put these numbers to? It's gonna be a very simple calibration. CR preferences, so these agents are risk averse. They're gonna be facing an AR1 process for the endowment of soybeans or whatever your favorite analogy is. They're gonna have standard quadratic default costs that make it such that defaulting in really, I mean, Agustin knows this obviously, defaulting in really good state of the economy is so costly that you won't do it, and that will tend to mean that you default really in relatively bad states of the economy instead. So far, standard stuff. So I'm gonna tell you that I just use some benchmark numbers here for the calibration of those. I'm going to just in this exercise, I'm gonna basically set this high level of China debt to be 0.4. So it's going to be so it's going to be 0.4, which is sort of, it's not the median, it's higher than the median, but it's not crazy. And I'm gonna set the probability of switching, meaning the probability of, right now it's completely symmetric, the probability of having an inflow if you didn't have a debt with China, or having to pay back if you had debt with China, to be 5%. So essentially you can remain in a world of not having to pay back, or not having any news from China for quite a bit. All right, what do we get? The first column here is just gonna show you what I get on conditions. So think about this economy when I'm just going through and I'm thinking through just this equilibrium, not distinguishing sort of high versus inflow versus outflows. So this is there is the obviously there is what I want you to see here is that the baseline model sort of behaves. I'm looking at the time and I want to get some key results. So I'm actually going to contrast things right away. So I'm going to focus just for the sake of, in order to be able to drive my, can this work? Yeah, okay. I got it. So these are inflows from China and these are outflows. You can see that when you have outflows from China, when you have to pay China, you issue more, and when you got an inflow from China, you deleverage from the market. Think of it as fact number one. When you have outflows from China, it's actually more expensive for you to borrow compared to how much you have to pay when you have inflows from China, right? It's about it's 200 basis points more expensive to be it's 200 basis points more expensive to borrow when you have outflows from China. Of course, in my model, my outflows are not strictly speaking the restructuring events I'm using in the data, but if you allow me to sort of think of that as the outflow, that's what I get. What part of the reason is exactly the default frequency. It becomes more attractive to default on market debt when you have to basically cough up so much to China, especially when you're in bad states of the economy, right? And obviously, yeah. So that's I'm gonna say those are sort of some of the benchmark. Oh, I made this a mistake again. I'm not a web-based expert. So in the interest of time, let me now sort of try to explain. I have 5 minutes and I want to be able to get some feedback. I'm gonna skip this, we can talk about it later. I do a simple exercise, which is not very insightful, but it's useful, which is, okay, will these countries ex ante choose to engage in this world? Meaning give them the choice between two worlds, where you have like your usual stochastic endowment process and you try to smooth just away from the markets, a world where you have that plus this sort of inflows and outflows from China with these tail events of inflows or outflows, but you know the market is going to respond. Which one would you choose? Well, it's a steady state to steady state comparison. It's not, there's no transition here. The countries obviously they have cheaper prices in so I see some questions. Actually, I'm gonna sort of quickly wrap up here and answer the question because I want to ask what you talk about. They will like it, but the advantage is actually depend on the state of the economy. Essentially, when you are really the gain can be really big if things are bad enough for you if you want. And if you're really in good states of the economy, you may not really benefit so much from the relationship. One last thing, because this is important, I talk about opaqueness, but I didn't talk about it. In this world, everything is full information. One thing we've been thinking hard about how to simply in a tractable way start doing exercise that speak to transparency issues or like limited information. Think of a world where this probability pi, the probability pi of switching, having an event, right now was symmetric, but could have been asymmetric. You can think of a world where lenders are optimistic or pessimistic. Imagine a world where when they see that you have a high level of debt with China, they maybe overestimate the sort of downplay the probability of having to repay, and maybe even overestimate when you haven't borrowed from China the probability that China will extend the loan to you. We can then use that to actually estimate these fees and omegas, if you want, to actually explain the data points we have, and then do counterfactuals where we can then change the degree of sort of market bias or market openness, or actually do an exercise we endow them with more information. So that's kind of one thing we want to do. I want to answer the question, so I'm just going to wrap up quickly here. Say, hey, this is still early project and a relatively early project still, but we document significant effects of Chinese debt events on sovereign debt prices and dynamics. We use a simple benchmark model to rationalize this, and we think that the model is simple enough to allow us to actually add maybe more complicated information friction counterfactual and think about other reforms concerning sort of the what we know or we don't know enough about Chinese lending terms. All right, so I think there are some questions. Should I just take them or?
Yeah, go ahead, Illenin. I think there are a couple of questions. So
okay. All right, so let me quickly look. Questions from YouTube. Are there empirical or inferential data that suggest China is willing to lend on poorer countries or weaker project economic fundamentals? Okay, I don't know about the weaker fundamentals. I don't think I've seen data on that suggests that sort of there's a correlation between sort of poor performance in China. But I think people have tried hard to ask if essentially the loans are essentially are subsidized, if you want, right? And I really invite you to read the work of Oh, okay. For a second, I thought I lost my connection. My overlifted lost connection, so I was worried. No, Horn, Reinhardt, and Trebesh, and the references in there have some amazing references on exactly the question on how fair the lending terms are. I hope that answers the question. Yeah. Any other questions? Thank you, Isa, Zait, Isa.
Well, if we have 1 minute more, I would like to make another question.
Yep.
In terms of this welfare analysis, like, did you calibrate the I mean, I was a little bit confused when I was reading this. Like, did you calibrate the other economy, or
No.
you just change one parameter of the model?
No, we just turned off the China debt. So we didn't recalibrate. We could do that because you could. Yeah, no, I know exactly what you're saying. We that's not what we did. But honestly, I don't think this is. Yeah, we didn't do that.
Okay, yeah, it was just confused.
Yeah, no, yeah. But I know what you're saying. Yep.
Perfect. So I mean, we finish on time, and thanks a lot. It's a very interesting like topic, and the model is so simple that it's very easy to follow, but at the same time super insightful. So thanks a lot. Jafat, do you have any question?
No.
Okay. So yeah, thanks a lot, Illenin. Maybe we can talk later. I will send you an email.
No, of course. Yeah. Shafat, thank you so much. Agustin, thanks for hosting. Stella, thanks for being on the back end. And I know there was also okay. I thought somebody else was helping us, but I
think Satya.
Okay, Satya, exactly. Awesome. All right. Thank you.
Thanks very much, Illenin. I guess if we've ended the seminar, we can. I just wanted to discuss few questions which are not crucial, but I think we were running out of time, so I thought I would just